you are a stock investor, you need to understand the three financial statements. That's the balance sheet, the income statement, and the cash flow statement. In this video, you'll learn what they are, where you can find them, how to read them, and what they tell you about a company. When people talk about the three financial statements, they are usually referring to these three: the balance sheet, the income statement, and the cash flow statement. The financial statements are reports created by the company's accountants which aim to tell investors or lenders everything they need to know about the finances of a company. The financial statements will appear in each quarterly report, called a 10Q, and annual report, called a 10K. Each financial statement serves a different purpose, as I'll show you in this video. The balance sheet usually looks something like this. It tells you what a company owns, these are called assets, what a company owes to other parties, such as its workers, the taxman, and lenders, these are called liabilities, and what a company owes to its investors. This is called shareholders' equity. The balance sheet will show you a snapshot on a given day, usually the last day of a financial period, such as the 31st of December. A financial period will usually cover a quarter of the year, half a year, or a full financial year. You can think of the balance sheet like your net worth. You have the things you own, such as your house, your car, and your savings account. These are your assets. You have the things you owe, such as your mortgage or your car loan. These are your liabilities. Finally, you have the difference between the two. This is your net worth, or equity. A balance sheet is called a balance sheet because it must balance. What the company owns, the assets, must be equal to what the company owes, the liabilities, and shareholder equity. Next, we have the income statement, which will usually look something like this. It tells you how much money the company made from selling its goods and services. This is called revenue. What the company spent to generate that revenue, this is called costs and expenses, and the difference between how much the company made and how much the company spent, this is called profit or income. An income statement will cover a period of time. For example, a quarterly income statement might record the revenues, expenses, and profits generated from the 1st of January to the 31st of March. You can think of the income statement like your personal net income. You have your annual salary, this is like your revenue. Then you have all your expenditures, such as groceries, rent, fuel, bills, and taxes. Finally, you have what's left over. This is like your profit or net income. Not all profit turns into cash, and not all expenses involve cash being spent. That's why accountants invented a third financial statement, the cash flow statement. It tells you how much cash flowed in and out of a company. Just like the income statement, it will cover a period of time, such as the 1st of January to the 31st of March. You can think of the cash flow statement like your bank account. You have the cash that comes into your bank from your wages, and you have the cash coming out for all your expenditures. If you look at your bank statement, you can see all the cash that came in and went out of your account. The cash flow statement is broken up into three main sections: cash provided by or used in operating activities, cash provided by or used in investing activities, and cash provided by or used in financing activities. Operating activities are the main business activities. If you sell cupcakes, it includes cash earned from selling cupcakes, as well as the cash spent buying things such as flour and sugar. Investing activities is the cash spent on investments. Investments can include things such as a new mixer or oven, but also includes investing in things such as other businesses. Financing activities is how you finance your business. This might include the money you invested personally into the business or a loan from mum and dad. Let's summarize. The balance sheet provides a snapshot on a given day into the things the company owns, called assets, the money the company owes to third parties, called liabilities, and the money owed to its investors, called shareholder equity. The income statement covers a period of time, such as a quarter. It shows you how much money the company brought in from sales, called revenue, how much it spent generating those sales, the costs and expenses, and how much was left over, the profit. Because not all revenues and profits actually involve cash coming in or out of the business, we have the cash flow statement. It records transactions that involve cash flowing in or out of the business. The three financial statements give you valuable insights into the business, such as how profitable it is, how much it is growing, and how much debt it has. If you want to learn more about the financial statements, check out my Financial Statements Masterclass playlist. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.